Hello everyone, welcome to AM FinTech Risk Management System. The system helps you construct portfolios based on factor model, optimize portfolio, and above all, evaluate risks. I'm going to guide you through the process of using our system and show you all the functions that we have. You can get access to AM RMS through AM website under AM Products, Risk Management System. Please use this button below to register your account to log into the system. First, you need to select the data source you want to use. You can either upload your own data or load from our database. I will first show you how to upload your own data using a simple file. A simple file can be downloaded here. Your data need to follow the same CSV format. Click this Choose File, then upload CSV file. The system will automatically recognize the start and end date of your data. You can also choose any period in between. Then next. Now you need to choose your simulation parameters. Data window size indicates how far back historical data used for estimating assets return and covariance. Rebalancing period means how frequently the portfolio will be rebalanced to the optimal weights. For example, 3 months indicates that your portfolio will be rebalanced every 3 months. Add. Then next. We currently support 4 different portfolio optimization algorithms. I will briefly explain them and their advantages. If you want to know more about these models, please click this question mark to explore more. Markowitz algorithm. In 1952, Harry Markowitz first applied mathematics to portfolio management. It then became the foundation of all modern portfolio theories and earned him a Nobel Prize in economics in the 90s. Since high return and low risk is a priority for risk-averse investors, Markowitz theory can balance between maximizing portfolio return and making the portfolio less volatile based on investors' risk aversion level. These are the parameters available for Markowitz algorithm. You must fill out the red sections, estimation model, and risk before moving to the next step. Simple mean. Use mean of the simple data in the estimation window as expected returns. Linear shrinkage, pulling the extreme mean values toward the portfolio average. Equal mean. Assume each asset has the same expected return. This essentially ignores the portfolio return maximizing part. It gives a minimum variance portfolio, one of the smart beta portfolios. Covariance matrix estimation model. Simple covariance. Use the simple covariance of the data within the estimation window. Linear shrinkage. Pull the extreme covariance values towards the group mean. Nonlinear shrinkage. Individually modify the extreme covariance values. This is the best known method to estimate covariance matrix. Equal correlation. Assume every 2 different assets has the same correlation. Then add. For risk aversion coefficient, a higher risk aversion coefficient means investors are more willing to aim for higher portfolio return by risking a more risky or volatile portfolio. You can use position limits to set minimum and maximum weights for any assets. For example, if you set all minimum weights to 0, then short selling will not be allowed, hence a long-only portfolio. Then you can finish the Markowitz configuration. Next. SOCP stands for second-order conic programming algorithm, allows investors to handle nonlinear constraints. These are the parameters available for SOCP algorithm. You must fill out the red sections, estimation models, and risk, before moving to the next step. Return estimation model and covariance metric estimation model were all explained in the Markowitz algorithm. Risk aversion coefficient was also explained before. I will now explain these optional constraints. Market impact. The impact of trading to the market. It usually applies to a large volume trading. Position limits, same as in Markowitz algorithm. Blacklist. Weights of blacklist assets will not be changed between rebalancing. Max loan. This is the minimum allowed weight of assets. For example, if you set max loan as 0.3, then the weight of asset is at least negative 0.3. Then you go back and finish. SAM algorithm. SAM is a recent breakthrough in mathematical portfolio optimization and is one of the most advanced and effective asset allocation model known so far. The fundamental insight is this: observed data or historical data are fundamentally stochastic. It is only one of the many possible realizations. Given the same stochastic nature of the market, say 10 years ago, we could have observed a different historical data. Instead of optimizing a portfolio or any trading strategy for the same reason with respect to one particular data, we should optimize a portfolio with respect to the true stochastic nature of the market. That is the true underlying joint probability distribution of the assets. The result is that the portfolio constructed or the trading strategy will be more robust. It is especially more robust during market crashes. Based on our research, SAM outperforms 1 over n equal weighting in a wide range of parameters. It is the most advanced and effective asset allocation model known so far. For SAM algorithms, the parameters are the same as in SOCP algorithms. One over n is the equal weighting algorithm. At each trade balance, the whole capital will be evenly distributed among all assets. In fact, before SAM, 1 over n is the best known asset allocation algorithm. There are more than 1,000 academic papers and 70 years of industrial experience that documents 1 over n in general outperforms Markowitz. You can choose whether to apply a diversification model to your portfolio, or you can skip this step by click Next. For diversification, we now support only covalent algorithm. Return relaxation, how much we can deviate from the optimal portfolio return. Variance relaxation, how much we can deviate from the optimal portfolio variance. I will skip this for now. Now you can access your configurations through here. If you have multiple configurations, they will all be showing here. You can choose the ones that you want to do simulation with by checking the boxes on the left side. Run simulation. When you see the status shows done, you can then go to reports. Here displays all the simulations that you have run before. You can click any one of them to see the report. Our report includes profit and loss plots, vital performance statistics, wins over time, and executions. You can download the report in PDF format that contains all the details. We also provide CSV format files, executions, measures, weights for you to download for your further analysis. We will go over the report section in more detail later in the video. Now let's go over the process of loading data from our database. You need to set the start and the end date of the backtesting period, and the data window size, rebalancing period for the portfolio construction. In the stock selection page, you can select stocks by setting up the relevant stock filters. You can select stocks by, for example, market capitalization and P/E ratio. You can also explicitly type in the symbols in the whitelist box. Blacklist. These are the stocks to be removed from the filtered results. They will not be added to the simulation. Then click Apply. All the stocks selected will be showing here below. Next. You can choose vector models from our model library. There are a few pre-built models. Alternatively, you can also build your own model. We have a long list of vectors that you can pick and choose. Confirm. All the parameters down here were already explained in the previous section. Same for the diversification models. We already explained before. Now you can access your configurations through here. You can choose the configuration you want to run simulation and do the simulation. You can refresh the status to see if the simulations are done. When you see the simulation shows done, you can then go to reports. Here displays all the simulations that you have done before. You can click any one of them to see the reports. You can either check the results separately by clicking their names, or you can check them together and compare. You can also download the result as a PDF or CSV file, including details. To compare several models together, let's use these two as an example. Please check the boxes on their left side and compare simulations. The system will plot their profit and loss on the same canvas and provide a comparison of performance measures. This is one of the profit and losses graphs of your models. This one is with no commission. We provide 32 statistics and 10 different graphs to help you analyze the performance of your models. For example, start and end balance, profit and losses, cumulative return, compound annual growth rate, maximum drawdown percentage, and distributions of returns. Quantiles of returns, daily returns, monthly returns, yearly returns, benchmark comparison, drawdown and recovery, top 10 positions. We also provide weights over time in percentage, time series of weights, executions of each asset. Here, you can also download the reports in PDF format that contains all the details. We also provide CSV format files, executions, measures, and weights for you to download for your further analysis. Thank you.